This video series is educational in nature rather than advisory. It is always important to consult with your financial advisor before investing. Position Sizing Technologies. Position sizing is a trademark of Position Sizing Technologies. Dr. Van Tharp's Secrets to Profits, the Position Sizing Workshop. This workshop is about position sizing, and it covers strategies that control how much you should invest in any investment or trade throughout its duration. It's the key to meeting your objectives in the market. Tape 4, Advanced Strategies. And once again, Dr. Tharp.
Okay, so this is a beginning of tape 4, and in tape 4 we're going to cover more advanced, more sophisticated strategies that I don't recommend you use until you really begin to get a good feeling for all of this. But in this tape you're going to learn how to make really high rates of return. And again, really high rates of return can also mean very large drawdowns if you don't know what you're doing. So you've got to really begin to have a good feeling for this material before you apply anything that we're going to talk about in this tape. You're also going to learn techniques for smoothing your equity curve, which means making sure that it's more something that goes straight up as opposed to something that has lots of bumps. And you'll also receive overall guidelines for how to apply all of this material that you've learned in this whole series. So let's look at some techniques for how to make high rates of return. And overall, there's two that I really like. First is scaling in. And you saw a really good example of scaling in on the second tape. You know, when the stop went to break even, you bought more. And when it went up to break even again, you bought more, up to 4 times. So that's scaling in, but there are a lot of ways that you can scale in. We'll talk about all of them on this tape. And the second is what I call risking a higher rate on your profits as opposed to a base rate on the money you start out with. So your core equity is, say, 0.5% risk, and then your profits you might risk 5% or 10%, whatever seems like a more optimum value for you. So let's first talk about some of these scaling in methods. Remember, you already know one of them that we showed you on tape 2. So scale in is when the stock moves a predetermined distance in your favor, you might scale in. Now, in our second tape, again, we scaled in when the stop went to break even. So that means that it was a 25% stop. When it moved up, so that now, if it goes down and we get stopped out, we don't lose any money, then you add another 1% risk. And we keep doing that. But you could do this when it moves up, when you lock in maybe 50% or 33% or any percentage at all. So there's any number of ways you can do this. You can have any given percentage. You can also scale in when the market gives you additional technical buy signals. As the example on Yahoo on the last tape, we had a number of breakout points in there. Those were all examples, so places you could break in. So the market makes a slight retracement and then breaks out. That's a new place you could scale in. Every time it does that, you could scale in, put your stop underneath the old lows. Or just the low of the day if you want tight stops. When the market is oversold and starts moving in your favor, that's another time. So the market seems to, you're in it, it hasn't reached your stop, but it seems to get really down and somewhat oversold. That might be another time to scale in. As the market moves up, it continues to form new bases. So there'll be at least 3 major bases when a market moves up. Out of each one of these will be flat periods or slight decline periods, and then it'll move out of that. Every time it moves out of those bases, those could be opportunities to scale in. So those are some examples. You could scale in all your profitable positions when your profit increases by some multiple of R, or your portfolio goes up in value by some particular amount or some predefined percentage. For example, let's say you decide to scale in when you have a 2R profit. So your market's gone up. Initially, you say you had a risk of $5. The stock goes up by $10, so that's a 2-hour profit. So now you add an additional risk unit, which might be another 1% risk. Notice that this particular one, it doesn't have anything. The other one was a predefined percentage of your stop. This doesn't really have anything to do with your stop. It's based on some R multiple increase in profits. You might say when your portfolio goes up in value by 10%, I'll scale in maybe 1/4% to every profitable position. Be another idea you might do. But these ideas for scale-ins are just suggestions, and you've got to determine if they're going to work for your objectives and what you want to do, because they're all somewhat risky. There are ways to give you huge rates of return, 100% or more a year, but you've got to have this all together, and you've got to really predetermine what it is you want and what your methodology is before you apply any of this. And some additional precautions for scaling in. First of all, you really need to limit the number of times you scale in. In our example on the second tape, we limited that to 4 times. I mean, stock could you could say, well, if I move the stop up 10%, I'll scale in. Well, on some of these big stocks, you might end up scaling in 50 times. That would be the only stock you'd own, and you have a huge risk. So I'd really recommend that you limit the number of times that you scale into any given stock, which might be, I'd say 5 is probably the maximum. You need to limit the total amount of risk exposure you have in a given stock to maybe 5% total. You need to limit the number of total exposure you have in your whole portfolio. So if you look at every stock and where the stop is, for each position, you're going to say, I've got so much risk, so many dollars at risk. If you total all those up and figure out what percentage of your portfolio that is, you probably want to limit that to some fixed percentage, like maybe 5%, 10%, 20%. You know, how much? Because that's really how much you could lose. For those of you who don't have any stops, you can lose it all. You're already saying, I potentially am willing to lose it all. So in your case, it probably doesn't matter. Your portfolio exposure is 100%. But for those with stops, you want to limit the total exposure. You say, I don't want to lose more than 10% of my portfolio value. So that might be a limit you'd have on all of this. And you always want to know where you stand with respect to margin. If are you scaling in so many times and you're not even thinking about margin, next thing you know, you get a margin call and you have to get out of some of the positions you've gotten into. You don't want to be in that position. So that's the first topic. That's scaling in. I've given you a number of methods for thinking about scaling in, and then a number of methods and precautions for how to limit the amount you're scaling in and limit how much risk you're going to be subject to. So now let's talk about the other method of really going for optimal bet sizes, which is to risk a small amount of your base capital and then risk even more when you have profits. So a conservative percentage of your starting equity might be 0.5%. So you might risk 0.5% of your starting capital on new positions, and then as it goes up, as your portfolio goes up and you have lots of profits, you might risk a much higher percentage of those profits. And then you also have to understand at some point in time, you then move your profits into the base equity, where your new positions then only risk that small percentage again. So let's get an example and see how this works. Let's look at an example of how to apply this. You start out with $20,000 and you're going to risk 1% of that account, or $200 for every position, okay? But when you make profits, you're willing to risk 5% of your profits. So you start this out, and then the next month your account moves up in value by $2,400. You've now got $2,400 in profits. So now you're going to risk 1% of the base equity still $200, but you're going to risk 5% of your profits, 5% of that $2,400, which is $120. $120 plus 200 is $320. So look how much your capital, well, your risk has gone up. Your capital has gone up just 12%, but now your position sizing has gone up 60%, which allows your profits to really grow. So how do you decide what percentage of profits to risk? How do you know what's optimum? Well, theoretically, you could calculate all that and get some rough idea. But I recommend a very simple formula that all of you can apply. And the first thing is, based on everything you learned in the first tape, you figure out the expectancy of your trading system. Okay? And you take that and you look at that expectancy and you divide it by the worst R multiple against you. So you either divide it by that worst R multiple or you divide it by 15, depending on whichever is greater. If the resulting number is less than 10%, then you use that number. If the resulting number is greater than 10%, then let's limit it to 10% as a ceiling. So those guidelines might be really volatile for some of you, and you've really got to know yourself to know if you could even handle those, but they're fairly conservative numbers. So in our sample trades on tape 2, the expectancy for that system was 2.4, meaning every time you take a risk or your trade, your average gain is going to be 2.4 times what you risked. When you divide this by 15, you get 16%. Now, since 16% is greater than 10%, we use 10% in our ceiling. So thus, if we have profits amounting to $20,000, we'd be risking 1% of our base equity, or $1,000, and we'd be risking 10% of the profits, or $2,000. Our risk would go from $1,000 to $3,000, or from 1% to 2.5%. That's how this works. Now, the second question you've got to ask yourself when using this particular method is, when do you return profits to the base equity? So that means at that point you're only risking that small amount that you risk on base equity. So you might do it after so much time or so many bars. For example, at the end of the year, you pay taxes on all your closed out positions, so you probably ought to consider all your closed out positions then your money. Gather it all in, and that's what you risk. That's now your new base equity, and the next year you start risking from the base amount. If you're trading other people's money, you're a money manager, they don't like drawdowns, so if you show them a huge profit, even though it's open, you know, they don't want to see it drop down. So at the point you report to them, you probably ought to consider the money base equity again. So those are just a couple of examples with time. You might return money to the base equity after a certain percentage of gain. For example, if you make 100% in your money, you say, okay, after 100%, then it's all my money again. It's all base equity. After a certain dollar gain, for example, if you make you need $25,000 to live on. You make $25,000 on your profits. That's enough to live on. Now it's all my money again. It's all base equity again. The other way you might do it is, you know, we're in a nice bull market. You have gain, 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 gain. Suddenly you have a losing month. You don't know if that's going to continue. So at that point, you suddenly return all the money into the base and you start at a new base level. So if your count drops, say in October, your count drops 3%, automatically all the money again becomes base equity. Or say you have some objectives. When you meet the objectives, you might return profits to the base equity. So that might be after 3 winning months, I return profits to the base. However you define it. And lastly, there's probably an infinite number of mathematical formulas that you might use to apply to this. For example, you might say, I'm going to use a fourth of the profit from the last 2 months and call that the money that I'm going to risk the higher percentage, and then everything else is the base equity. So in that particular case, it would be how many months and what percentage of it would be the mathematical formula. So you can see there's an infinite number of possibilities for how you could do this. And it all has to be designed around how you want to use position sizing to meet your objectives, which is our main criteria. So let's take a look at the examples that we used in the second tape and show how that might be applied to using base equity. So in February 1999, we had equity of $100,000. We're going to risk 1% of our base, which is $1,000, 5% of our profit here. We have 0 profit, so our risk on all new positions would be on $1,000, or $1,000 risk. In March, our portfolio is now worth $100,351. We have $351 of profit. A base is, again, 1% of the base. So you have $1,000 risk on the base, $17 risk on the profit. So you're now risking $117 or $1,017 per position. April, you now have $1,856 worth of profit. 5% of that is 92, so you're now risking $1,092 per position. So see how it's going up? It's going up faster than if you just risk 1%, which before would just be 1,018 here. In May, now you have $5,559 worth of profit. So you're risking, again, the $1,000 base and now $279 in profit. June, now suddenly we have a losing month. So our criteria is going to be to reset it. So now what we have is 104,111. So our base is 1% of that, or 1,041. We've reset, so we have no money there. So our total risk now is 1,041. And we keep going now again until we have another losing month. So that's an example of how this might work. Okay, so our next topic is how to smooth your equity curve. So the idea here is not to go for maximum rates, but how to make sure you're not getting so many up and down movements in your equity curve. So, and these usually involve reducing your position sizing during the process of the trades. So one idea is to maintain a maximum open risk. Another idea is to maintain a maximum open volatility. And then a third would be to do some combination of those. Okay, so here's a sample situation. You purchase Qualcomm at $40 a share with a real tight stop of just $1. Your initial risk is $500, so you're purchasing 500 shares. Now, this is a great stock. It goes up in 3 months to $120 a share. You're using a 25% trailing stop, so your stop is now at $90. You got $30 risk per share. $30 risk times 500 shares is $15,000 of total open risk. It means your account could go down by $15,000 to get stopped out, and you might watch, every day as Qualcomm goes up $5 or down 10 or whatever. You're watching your account fluctuate by $5,000, $10,000 at a time. Gives you trouble sleeping. So what you do. Okay, so your account is now worth $120,000. And what we're going to do is we're going to maintain a maximum open risk of just 3%. So your account, as I said, is now worth $120,000, and 3% of that is $3,600. So your risk per share in Qualcomm, though, is $30. So what you do is you divide $30 into that $3,600 maximum risk that you want to keep, and you get 120 shares. So you can keep 120 shares, and you have to sell off 380. And now you can make this kind of adjustment monthly, daily, quarterly, hourly, however often you want to make it, but just so it keeps you sleeping well. Now, another method is to maintain your open volatility. Volatility is how much the stock fluctuates on a daily basis. So if this stock's fluctuating all over the place, you want to maintain that, the amount of volatility you're exposed to, at a constant number. So you're going to say, I'm going to keep that at a maximum of 2% of my account. Your account's worth $120,000, so 2% of that is $2,400. Daily volatility of Qualcomm is $8. So you divide $8 into 2,400, and you get 300 shares. So you can keep 300 shares. You have to get rid of the other 200. So now, you know, based on how much the stock fluctuates, you're again maintaining a constant level. And again, you can make this kind of adjustment hourly, daily, weekly, monthly, however often you want to do it. So, and a third solution would be to do whatever is the smallest of those two. So solution 1 allowed you to keep 120 shares. Solution 2 allowed you to keep 300 shares. 120 shares is less, so that's what you do in that particular case. And again, you can do that kind of adjustment hourly, daily, weekly, monthly, quarterly, yearly, you know, so on, however often it feels comfortable for you. So we've gone over some really advanced strategies here of scaling in and using a base bet and then risking a higher percentage of your profits. And a lot of material on these tapes. So let me go through now how you can apply this personally and how to make the most out of this. First of all, what I'd like you to do is go through these 4 tapes over and over again. Work through the examples until you really understand them. That's really important, because a couple of repetitions and you'll have the stuff down. And once you've got it down, then you can really apply it. Second step is to understand what kind of trader or investor you are, what you want to accomplish. And I think my home study course really helps drive home this point, so I recommend you take a look at that. And thirdly, as you know what kind of trader you are and you get a sense of who you are and what you're trying to accomplish, you need to really lay out your objectives very clearly.
You are the most important factor in your trading. Work on yourself. Learn the results of Dr. Tharp's modeling work with successful traders and investors. The 10 tasks of trading. Traits of top traders. How to work on yourself. And real secrets to profits.
Now, once you've laid out all these objectives, what I'd like you to do then is develop a method. And I've shown you a lot of methods with stops that will really help a lot and that give you a positive expectancy. And you know what expectancy is from the first tape. And a number of ways you can do that. William O'Neill has a great system called CAN-SLIM that's in his book. It's one of the most popular books, How to Make Money in Stocks. Read that book, apply that system. That's a great way to make money. You can simply buy stocks that are going up. Look, if they're going up and they're a straight line, they're good ones to buy. So if they're going up, they have good relative strength, buy them, keep a 25% trailing stop. You can follow somebody's recommendations if they have a good track record. But I'd always make sure when somebody recommends a stock that it's going up. You know, if they say it's overvalued and it's going down, it might continue that way. So make sure it's going up first before you buy it. And again, keep that 25% trailing stop. Or, you know, if you don't want to do that and you really want to get very sophisticated, I have a course that'll show you how to apply all of this material.
If you want to develop a system designed to fit you, then consider buying a tape series that gives you the information to design a system that's right for you.
The next thing you do when you've got all of this laid out is to apply a position sizing strategy that meets those objectives. Perhaps you want to pick a simple percent risk position sizing and risk between 0.5% and 1% of your equity. You might want to do that with scaling in. That works very well. You might want to smooth out your trading with scaling out. So you could scale in and then also scale out. And really get to understand the effects of position sizing. To do this, I suggest you really, when you got the R multiples from your system, we have a trading game that allows you to apply various position sizing strategies. I'd suggest you try that game, play it, get to the point where you understand it. And when you understand it, you can also plug in your own system with your own R multiples from your system, and then try different position sizing strategies with that. It's really a lot of fun, and you'll learn a lot from doing that.
Play a game to learn position sizing and simulate your system. The Secrets of the Masters training game allows you to get a feel for position sizing as you master a 5-level game. It also allows you to enter your own R multiple distribution and thus simulate your own system.
I also recommend that when you begin, you start very small. Start with small positions like 0.25% to 0.5%. And you know, if that means you only have a $20,000 account, and so you can only risk $100 or $50, and you're buying a $50 stock, so you can only buy, with a $5 stop, you can only buy 10 shares. Well, only buy 10 shares. Or only buy 1 share. Getting the principles down and doing that, with $50,000 and $100,000 accounts, if you apply these principles, sometimes you're seldom, especially small, tight stops, sometimes you're seldom buying just a round lot. You're usually buying 33 shares or 62 shares or something like that. So don't be afraid to buy odd lots. When you're familiar with all of this and you know it works, then you can increase your position sizing to something that ramps it up and gives you bigger rates of return. So what I'd like you to do is go through this tape series 3 or 4 times until you really understand the principles and you have it down. And once you've done that, if you still have a few questions, feel free to call my office. We'd be happy to answer any questions that you have about the material. And just get started. Do it now. We really want you to meet your objectives, and to do that, you have to set your objectives and you have to get started.
This concludes Tape 4 and the Position Sizing Workshop. You should review all these tapes as often as necessary to understand the key points. You can get additional products created by Dr. Tharp at. We look forward to hearing from you soon. Thanks for being with us.